Hi, I'm Caroline Chen, and I am here to present the volunteering training for 2023, What's New Part 2. First, disclaimer, the summary here provides just basic information regarding the current tax law. Nothing in the summary, of course, supplants or replaces the requirements of the actual code itself. It's not meant to be a substitute for advice from taxpayers' own legal and or financial advisors. And of course, you can always find out more information about the current tax law at www.irs.gov. So our agenda today is that we're going to be talking about certain reminders, the child tax credit, educator deduction changes, required minimum distributions for IRAs, and earned income tax credit changes. So the first thing that I'm going to go over is some reminders. If you remember, the Tax Cuts and Jobs Act eliminated personal, spouse, and dependent exemptions, and that currently is the case. However, there's a gross income limitation for qualifying relatives, which is limited to $4,400. Some changes that we have happening to the child tax credit. Remember that children must not have reached the age of 17 by the end of 2022 in order to be considered to be a qualifying child. The current credit for a qualifying child is $2,000. This is a slight reduction from the COVID years, although there is an additional $1,500 that may be available per qualifying child. For educator expenses, this is for any teacher or educator from K through 12 only. That's been increased to $300 from $250. And although it's not a drastic increase, any expenses paid for regular school supplies and equipment used in the classroom will also be expanded to any personal protective equipment, disinfectants, and other sort of supplies used in a classroom to prevent the spread of COVID-19. And that's for any expenses incurred after March 12th of 2021. So of course would include the entire 2022 calendar year. With respect to the educational tax credits, the American Opportunity Credit for 2022 has a phase out that begins when the taxpayer's modified adjusted gross income is between $80,000 and $90,000 if they are filing single, and between $60,000 and $180,000 if the filing status is married filing joint. The lifetime learning credit for 2022 also is phased out if the taxpayer's modified adjusted gross income is between $80,000 and $90,000, and again for married filing joint taxpayers between $160,000 and $180,000. Now, the student loan interest deduction also has a phase out for taxpayers with a modified adjusted gross income more than $70,000. This would be more than $145,000 for married filing joint, and then would be completely phased out for single taxpayers with modified adjusted gross income of $85,000, and for married filing joint, it would be $175,000. So required and minimum distributions are from a IRA, and those are required for any taxpayer that reaches a certain age. So beginning on January 1st of 2023, the RMD age requirement has actually been increased to 73. Then in 2033, the age requirement will be increased to 75. The annual charitable deduction limit, which is now set at a maximum of $100,000, is going to be adjusted annually for inflation. And these adjustments will all begin after the 2023 tax year. With respect to the earned income tax credit, there are certain changes that are permanent on an ongoing basis from last year. So any single or joint filers who have Social Security numbers can claim the credit even if the qualifying children that they're using to claim this credit do not have Social Security numbers. The old law was that these filers wouldn't qualify for the credit at all because the qualifying children would have to have Social Security numbers. There's a limit on the investment income that taxpayers eligible for the EITC can have, and that limit on investment income has been increased to $10,300. Also, for individuals that can claim the EITC if they're married and not filing a joint return, but have a qualifying child who lived with them for more than half of 2022, would be able to claim the credit as long as they have lived apart from their spouse for the last 6 months of the year of 2022, and the couple is legally separated according to their own state law under a written separation agreement or a decree of separate maintenance, and then of course did not live in the same household as their spouse for the last 6 months of 2022. So with respect to the earned income tax credit, the earned income limitation amounts have increased. So if you have a taxpayer with 3 or more qualifying children and they are married filing joint, that means that their AGI has been increased to $59,187 in order to qualify for the credit. For 2 earners where you have married filing separately, as we just recently discussed, that'd be $50,057. And you can see here all of the different increments with respect to the AGI amounts. And of course, don't forget that taxpayers who have no qualifying children at all, as long as they make below this income limitation and no more, still would be able to qualify for the earned income tax credit. Now, the maximum EITC that you could receive, again, would be if you had 3 or more qualifying children, $6,935. And then you can see here as it goes lower as your qualifying children reduce. And again, at the very bottom, if you have no qualifying children at all, you'd still be eligible for an earned income tax credit. Thanks for your time and attention. If you have any questions, please feel free to email our administrator at this email address or double check our website.